Welcome everyone. My name is Crystal Brown. And I'm happy to be here today with you. I'm going to be presenting along with Ed Toy on investment governance. So I will go ahead and turn it over to him and get us started.
Okay, so welcome everybody. I always skip over the first slides because you people can read. You can read, right? Okay, so keep going. So we're going to be Crystal and I are going to be talking about, investment governance, which is like, I was talking to somebody earlier today, it's like every year I pick something that I'm going to be really annoying about. And this year it's investment governance. So we're going to start off with a few quick slides just to give everybody some context on why we think this is a big issue today, and maybe a bigger issue than it was 3-4 years ago. And we're going to go through these relatively quickly because if you heard me go blah, blah, blah in the past, these are all slides that you've seen before. Obviously one of the things that is very, very substantial from the standpoint of what's been going on, the last 3 or 4 years as opposed to the 20, 30 or 40 years before that, is that we had a huge spike in inflation back at the end of 2021 into early 2022. That caused all sorts of things to go sideways and backwards and up and down. Those inflation numbers have come down, with some very aggressive action from the Fed, but they are still a little bit above the Fed's target of 2%. The Fed, for those of you who don't follow the Fed, the Fed has a target 2% as kind of like that's a good, stable inflation rate. You got a decent amount of economic growth, but it's not overheating the economy. It's not causing disruptions. So we're still up above that. And the last couple months, the inflation rate has ticked back up, which is a little bit concerning because at the same time that the inflation numbers are ticking up modestly, but ticking up a little bit, is that the employment numbers are also starting to suck, which is, for those of you who were around long enough, you remember back in the days in the 70s and the 80s when we talked about stagflation. And I don't think anybody's used that word in a long, long time. But that's a significant dynamic. So we move on. This is an indication of what investors in general, and I'll say that now, and I probably won't say it over and over again, it's the whole investor community. Obviously, insurance companies are a part of that investment community, but the entire investment community has been dealing with this graphic, which is interest rates, generally speaking, rising gradually over time, coming back from that period when interest rates were horribly low. And then suddenly, we had COVID, and to get the economy going again, the Fed basically drove short-term interest rates down to virtually zero, which created all sorts of problems. But also, it resulted in, because the market wasn't necessarily following along with the longer-term treasury yields, it resulted in an inverted yield curve, which I know Kim Hudson knows. How many times have we had an inverted yield curve in the last 50 years? It's like 5 times. You saw his hand, right? So it's extremely rare, but beyond it being an inverted yield curve being extremely rare, they usually don't last that long, and they're usually not that inverted by that much. This time around, the yield curve was inverted by as much as 150 basis points, and it lasted almost 2 years. So, treasury yields have moved back. We're back to being positive again, but it's kind of like just barely positive, and it's got a kink at the front end of the curve, which is still crazy. Next slide. So in addition to what's going on with interest rates and all of that, sort of like, stupidity. I was searching for a better word, but all of that going on, obviously insurance companies don't only invest in U.S. Treasuries, they invest in some kind of risk asset, and this is a measure of credit risk volatility, and I follow 3 basic graphs. Single A's and triple B's, those are kind of like the sweet spot for most insurance companies. If you look at the industry data, the gray line is high yield, which is everything from double B plus all the way down to triple C. And you see some amount of volatility in the orange and the blue lines, but not a lot, and that's to be expected because those are basically investment grade bonds. You see a lot of volatility in the gray line. And I think from roughly 2008 to 2019, you didn't see a lot of volatility. And that's a basic theme here, that we're dealing with this change in the last 3 or 4 years, which has been substantial. And it's a very big change after 10 years of, we all hated the fact that interest rates were so low and struggling to get investment yield. But at the end of the day, everybody we kind of know what's happening in the next 2, 3, 4 quarters. We have a reasonably good sense. These days, we can't say that anymore. You had COVID back in 2020. You had the spike in inflation in 2021. You had what the Fed did with interest rates in 2022. You had the banking turmoil in 2023. Mixed in with all of that was the Russian invasion of the Ukraine. And then at the beginning of 2025, which is the last spike in the gray line, is what happened when the tariffs were announced, was Liberation Day. And you saw the differential, you saw the spike in high yield bonds go up by like 250, 300 basis points, in the space of about 2 weeks, after the announcement. So that's the volatility that we're dealing with. Now we see the exact same thing, or almost the exact same thing, when we talk about equity markets. And this is just the S&P 500. If I were to pull like the NASDAQ numbers, or one of the other kind of like indices that focus more on technology companies or biotechs or something like that, it would be even more extreme than this. But look at what happened at the beginning of 2025 in April, early April to like end of April, over a space of about 2.5 weeks, the S&P 500 dropped almost 20%. And a drop of 20%, what the significance of that is obviously not just the drop of 20%, that's bad enough. But there are all sorts of computer algorithms, computer trading systems that use different benchmarks. That if the S&P 500 drops by 10%, there are triggers that then there are sell signals. And if it drops to 20%, there are more sell signals, because 20% is considered a bear market in market parlance. So it's not just the drop got down to like 19.5%. If it had gone to 20.1%, I think you would have seen a bigger spiral. So again, emphasizing the volatility. And we didn't see that for a very long period of time, about 10 years. So that is the market environment that, generally speaking, we're dealing with. And then, of course, we move on to the next slide, which is the one. This is the slide I was pounding the table on last year, talking about commercial real estate values. And the most significant thing about this, which Hank House knows, because I did this 2 weeks ago in Little Rock. I actually got to go to Arkansas. That the front end of this curve, you look at the different property types, and keep in mind, these are just national index numbers, so they're the averages. You throw everything together. So the front end of the curve has all of those different property types basically moving in the same direction. A little bit of changes. If you were to blow up this graph, there would be a little bit of up and down, between retail versus apartment versus office, but they were generally going in the same direction and in the same order of magnitude. It was kind of like the old adage of, all high tides lift all boats. But what do you see in the last 5-10 years? Dramatic divergence in the different property types. Apartments, considered one of the more volatile ones, probably got a little inflated because of COVID, but it's still doing decently. Retail is, I think we generally speaking feel like that enough malls and shopping centers have been closed, so that seems to have stabilized really well. That's the red line, but the purple line is crazy. You look at today versus its peak. The national index numbers for commercial office space is down 39%. So imagine that you have a life insurance company that invested in a mortgage loan, with a 60% LTV. That is now 100% LTV. That is, and these are the national numbers, the big, huge average numbers. So, you have obviously office buildings that are doing much better than that, and you have office buildings that are doing much worse than that. That's the nature of an average. I mean, there was an article just last week about, prime real estate, granted it was a slightly older building, but prime real estate in Midtown Manhattan, 623 Fifth Avenue, which had Saks Fifth Avenue, major retailer on the bottom 2 floors. It just got sold 200 plus a little bit more $1 million, and which is probably a quarter of what it would have traded at 5 years ago, because it's 75% empty. This is Fifth Avenue and 60th Street. I mean, there's no better location than that. Right, Bill? Because Bill looks at buildings all the time. So moving on to the next. So in that environment, what have we seen in terms of changes in insurer portfolios? And insurance company portfolios have been changing a lot. And it has really accelerated in the last 4 or 5 years. It was doing that for a while as investors in general, including insurance companies, were looking for yield, trying to get a little bit, another 10 basis points, another 50 basis points. But there have been a lot of drivers of these changes. The first is the standard one, and that is changes in market dynamics. You've all heard me say that, when I started into this business way too many years ago, the typical life insurance company portfolio was 25 to 30% investment grade utility bonds. That world just simply doesn't exist anymore. Even if an insurance company wanted to do that, they couldn't do that. So market dynamics is driving a lot of stuff. Interest rates, obviously, when interest rates were really low, that drove insurance companies. Well, let me go a little bit lower in the credit spectrum. Let me stretch out to get some structured securities because I get an extra 25 to 50 basis points for that. Although one of the first exams I worked on, I asked the CIO why they had 20% of their investments in asset backs, and his answer was, well, I get 50 basis points more in yield. So who in this room thinks that's a good answer? So yes, not a good answer. So that's and then of course the last few years, looking at what's happened to interest rates, what has they done to every life insurance company's interest rate hedging strategies? They've all gone out the window. Reporting $300-400 million gains one quarter, $200-300 million losses the next quarter. All of those interest rate swap things are going all over the place. Valuations are crazy. So that's a big problem. You have the continuation of external investment managers, life insurance, especially life insurance companies, but also a lot of P&C companies dealing with this marketplace. They find I can't deal with it. The markets are too volatile. There are too many different asset classes. I don't have the people to do it. It all gets outsourced. Now, if they get outsourced to the big guys, and I won't name them because that would be bad, but you have a certain amount of faith that they understand the fiduciary responsibility of being an investment manager. They're registered under the 40 Act, which is one of the things that we added to the handbooks, right, Bruce? We added that's they should be registered as a registered investment advisor under the 40 Act, because that gives us a lot of comfort. They understand the fiduciary requirements. You get outside of those big guys and you start to wonder a little bit. Are they registered? Are they not registered? Is this an issue? But the external investment managers, they're all piling into this industry, into the insurance industry, because the view is, well, insurance companies, it's all sticky money. It's easy money because they don't trade a lot. They don't really do that much in terms of the crazy stuff. I charge a fee and I really don't have to work that hard for my fee. But do they really understand insurance company liabilities and insurance company needs in terms of the kinds of assets they should be investing? Of course, the next bullet is what the NEIC has been really crazy about, and to some degree appropriately so, with private equity-owned insurance companies. And the fact that private equity-owned, they come in with a different frame of mind. Some are long-term investors. They're in there for the long haul. They want to build this business. They want to add. They want to do all the right things, the same as any other insurance company owner. But there are clearly also those that are in there. They've got a fund. It's got a 10-year life to it. They need to do what they want to do in the next 10 years and then get out. And in the meantime, what do? They're also entering into an investment management agreement and using that to put different kinds of assets, and we'll come back to some of the assets that they're putting in. But also, the last bullet here is focusing on Their focus is on an asset-driven business. It's not a liability-driven business. And that makes a very, very big difference. So next, so changes in industry assets, we're looking at a lot of these different things and it's transpired. Assets are a lot less liquid. The structures are a lot more complicated. We have a growing exposure to mortgage loans, but one of my things is non-traditional mortgage loans. It's directly held residential mortgage loans. It's construction loans, and I won't go into that. There's a lot less transparency. These structures that are reported on Schedule BA. There's a lot less transparency, but also the reliance on private letter ratings, which are also a lot less transparent. There's a lot of comfort when S&P is out there with all their ratings. You get comfort that everybody's looking at them. A private letter rating, maybe not so much. A couple last points, and I joke, deja vu all over again. Private credit, when I was at Teachers Insurance, 98% of our portfolio was private placements. But we had a governance structure to deal with that because we knew what we had. It's a little bit different there. RMBS, who I can't remember who I was talking to earlier today about, we had, periods of time when there was a lot of RMBS exposure. It's been down to next to nothing for a long time now. Are the structures in place to monitor the cash flows and the prepayment risk? This is just kind of like an outline quickly of, we had issuer obligations, nice, clean, and easy. Now we have structured securities. We had publicly traded common stock. That was the predominant share of what insurance companies own. Now it's all private equity funds reported on Schedule BA. These are very, very different things. They're not the same. Commercial loans versus construction loans. The commercial loans, by that I mean your standard 65% LTV, 90% occupied, 2 times debt service coverage on a 30-year, fully amortizing loan. That's not that anymore. So moving on, leveraging assets. This is another big thing. I'll touch on these bullets quickly. We're seeing an awful lot of Federal Home Loan Bank membership. I happen to think that relationship can be a really, really good one, but we are talking about leveraging assets, leveraging surplus, pledging assets, and those assets are now restricted assets. Life insurance companies doing it with funding agreements, which are on the same level as policyholders, but also not subject to the automatic stay if you put an insurance company into rehab. It's a 10-day stay. That's all it is. You got 10 days to decide whether or not you're going to let the FHLB take all of their assets away. SEC lending and repurchase agreements, that's been kind of like flat, not too much happening, but obviously let's not forget the lesson we learned in 2008 with the duration mismatch. Special case derivatives. I already touched on very quickly what happened, because of the inverted yield curve, but we always look at the derivative use plan. Do they have the guidance? Do they have the structure in place to be managing a derivatives portfolio? So what is the impact of all of this? So we move on. So credit risk is, what do rating agency ratings mean? They mean risk of default. They don't say anything or virtually nothing about loss severity. And tail risk is a big deal when you're comparing a good, solid corporate bond versus structured securities versus different things that are reported on Schedule BA, especially things like collateral loans, which Maggie heard me rant and rave about it earlier today. A lot of tail risk with a lot of these different structures, that you don't have with corporate bonds. So next, market risk. One of the things I think we really don't do a very good job, quite frankly, within the NAIC regulatory framework, is what do we do with market volatility? We kind of see it, but how do we measure it? How do we kind of categorize things? How do we bucket things? What kind of market volatility can a company absorb, whether it's a life company versus a P&C company versus a health company? We really actually don't do a lot of that. And with what's been happening in the last 3 or 4 years, you're seeing tremendous gapping in market value prices. It's just not going, oh, it's down a couple points. These things are dropping 20, 30 points overnight. And that's a whole different situation. So the question comes up is, can the insurance company really continue to argue that they can buy and hold? that they can hold these things to maturity, because that's the basic idea behind amortized cost accounting and the way risk-based capital works and all those different things. If they can't hold to maturity, then a lot of their basic premises are subject to some question. Liquidity risk, I think, Crystal, you're going to do this one.
Yes. So liquidity risk, we're really asking the question is, can the insurer meet its near-term obligations without taking a loss in both normal and stressed conditions? And so when we're looking at this from an exam perspective, we're really trying to understand the asset and liability matching, and not from the actuarial perspective, but like what are they looking at and understanding the maturity and liquidity portfolios and the profile of those assets overall. And are they appropriately aligned with the insurer's liabilities? We're also looking to see if there is that mismatch. You know, if the company was forced to sell those assets, are they going to take a loss from that? And then how would that affect them overall? There's also the composition of the portfolio, the illiquid versus the liquid assets. So it's important to understand what the insurer is maintaining. Are they looking at that to understand if those are appropriate for their liabilities? From a liquid perspective, those are your treasuries, your agency MBS versus your less liquids, which are your private placements or your alternative investments, and balancing those out in the portfolio. We also look at the monitoring practices of the company from a liquidity perspective. And some best practices that we've seen are that they have systems in place to track their liquidity, not just from a quarter end perspective, but are they monitoring it on a weekly, on a daily, on a monthly basis overall. And then we also expect to see some liquidity stress testing. And when we look at that, we're looking to see, are they stressing for any adverse scenarios, such as market risk, market fluctuations, interest rate changes, and any other scenarios. And then we also look to see if they have a strong practice in place to stress test out over 12 to an 18-month period. That's really going to give them a good understanding of their overall liquidity profile. We have seen insurers that are using more liquidity backstops, such as the Federal Home Loan Bank, parental guarantees, and other committed lines of credit. We also look at it from a liquidity governance standpoint, and from that perspective, we're looking to see, does the company have a formal liquidity policy or plan in place that's been taken to the board that outlines certain key parameters, such as, you know, monitoring and managing that liquidity profile? Are they providing any reporting? Are they taking that to the board so that the board knows where that liquidity profile is at? Also, does that policy outline the roles and the responsibilities and the metrics for when a liquidity event is triggered? And so, like I said, this should be something that is board approved and authorized and reviewed, not just one time, but that they go back and they look at that annually overall. And then we do have some key questions that we're usually looking at whenever we go through the liquidity piece of the exam from an investment standpoint. And like we just talked about, one of those questions is, do they have a formal liquidity policy? Does it define those thresholds, those roles, and that escalation procedure? How often is it reviewed and updated? Is it monitored at just an investment level, or is it monitored at an operational level, or is it monitored enterprise-wide? We've seen some companies that do just an investment stress testing or investment monitoring of their liquidity, but then we've seen others that will bring it all together. And then what metrics do they use? We're also looking to see what is their liquid assets versus their illiquid assets, and then if there's any internal limits on what those illiquid assets are. And then how do they use any of those backstops? Are they using a Federal Home Loan Bank as a backstop? And if so, how are they doing that? What are those metrics? Is that even defined in the policy as well? And then we also look to see if there's any documented procedures for accessing those backstops. And then how is the company conducting its stress testing? So really, liquidity isn't just about having enough cash. We look at it as a whole governance process and as a tool and as foresight to manage any uncertainty that the company may have if they have an adjustment to their investment portfolio. And Ed, back to you.
So, yeah, I mean, and I think, Crystal spent a lot of time on that because things have changed so much and portfolios are just not that liquid. And it's a multi-layered issue. You can have liquid assets, that's great, but if they're pledged as collateral to your derivatives party, then you really don't have access to them. Or, what we're seeing a lot of times with, especially life insurance companies today, is that the portfolio overall is 5 to 10% underwater in terms of fair market value versus carrying value. So now if they sell them, they're actually taking a loss. Whereas 6 years ago, they could say, hey, I don't want to sell these, but if I sold them, I'd actually be taking a gain. They can't say that anymore. And in fact, there are significant percentages of these portfolios that are 20, 30% underwater. And if that's the case, and they start selling even just bits and pieces, I think there's a significant risk that the auditors are going to say, you can't say you're buy and hold because the whole portfolio is now tainted. So obviously, I always you need to remind myself, because this is really important, the whole thing about what we do, what Crystal and I are doing about, looking at the assets and trying to understand how insurance companies manage them is meeting policyholder claims. Everything we are about is how do we deal with the liabilities? It doesn't matter, if we do a certain amount of analysis and we come up with a certain, metric, so to speak, about the liquidity or the market volatility, if we don't also understand the liability side of the equation. I mean, my old company, it was one massive pension fund. Harry Klistenfeld could forecast within like 0.5% what our cash flow needs were going to be next year. That's very, very different from what we see today with a lot of insurance companies with relatively short fixed income annuities, 3-5-year products, or MYGAs with all sorts of different kind of like crediting formulas that can be relatively complicated. It's a different world today on the liability side. I mean, S&P actually did some analysis a year or so ago and found out that, realized that more than half of life insurance industry's reserves are for annuity products, and a lot of them relatively short annuity products. It's not life insurance anymore. I mean, maybe we should change the name. It's not that anymore. So next slide. So governance. So this is what we're getting to now. Now we're diving into, all right, now what do we do about this? And we talked a little bit about this already. So fundamentally, what we're looking for, and I start with this basic premise, that as an examiner looking at a portfolio subject to state investment law limits and maybe a few other things, it's not our job to say what you can invest in and not invest in. That's not what we're supposed to do. But if you're going to invest in certain things, what is the governance structure that you've got around that? And when I say governance structure, I'm using that kind of like small g, small s, that it's all encompassing, it's everything. And it starts, at the end of the day, the responsibility of how an insurance company's investment portfolio performs relative to its liabilities starts with the board. The board has responsibility for that. Now, what they do, if you follow the arrow on the left side of the slide, is they send guidance down. They tell the investment committee, here's what you're authorized to do. Everything else is up to us. Here's what you're allowed to do. If you want to go outside these parameters, you come back to us and you get permission to do that. The investment committee, and we're talking, when I say investment committee, I'm talking about a board investment committee with actual board members on it. And that investment committee has that responsibility for a little bit more detail. They can then delegate down to the chief investment officer. Chief investment officer, you're allowed to invest in, all investment grade stuff, at your own discretion. Everything that's below investment grade has to come up to us. That's obviously just an example. The CIO goes to the portfolio managers and says, well, you have a discretionary authority for single A and up, corporate credit. Everything else needs to come to a committee that I chair, and then the portfolio managers send that down to the trading desk. But then on the other side of the spectrum is the information that needs to flow upwards to the board. That you have the trading desk, they have tremendous detail line by line, every single holding that they've got. They send a certain amount of information up to the portfolio managers so the portfolio managers can understand the risk of their portfolios. And then the portfolio managers send a certain amount of information up to the CIO. CIO sends a certain amount of information up to the investment committee. Investment committee sends information up back to the board. And then you start that circle all over again, because then the board looks at the risk profile of their portfolio and said, okay, we've got a little bit more room here, let's change our guidance and we'll send it down. Or we've got a little less room here because our liability structure is changing, so therefore we're gonna pull that back and say, you don't have to necessarily sell, but stop buying that stuff. So you've got, I couldn't figure out how to draw a circle, so I just drew arrows. So key components, obviously we start with the asset allocation. That if an insurance company, and I'll just give one example, and those of you know me that I could go on for days about this, but one example is if you're going to have a company that's going to invest 40 to 50% of their assets in mortgage loans, tell me why. How did you decide that that made sense? It's like, and the answer that I get way too often is, well, we adopted it. It's in the guidelines. It's like, no, I didn't ask you, how did you adopt it? Did you have guidelines? How did you decide that 50% from a risk appetite standpoint made sense? And too many times, I don't get a good answer. We need, once the asset allocation is kind of like analyzed and put together, which, our common, terminology these days is strategic asset allocation, then we have board adopted guidance. The guidance needs to be adopted by the board at least once a year, or at least reviewed once a year. Obviously, the guidance also should say, yeah, but, notwithstanding anything that's in these guidelines, don't do anything that's in violation of state investment laws, because we always want to have that. And then we have the monitoring and management by the company, by the senior management, along the lines of what I just described before, including regular checking for compliance with those guidelines. And there are a lot of systems that are building out these days. Some of them are accounting systems, some of them are very sophisticated analytical systems that you can put the formulas in there. It's not as hard as it used to be to keep track of compliance with your guidelines. Next. So what does this mean for insurance companies? I mean, I guess I've talked some about this, but you start with the investment committee in terms of monitoring and managing investment risk. And the most important thing that I put as a bullet here is we're not just talking about credit risk. I mean, you look at a company's reporting to the investment committee and they've got all sorts of great detail about credit ratings and EIC designations and upgrades and downgrades. And I ask them, well, do you keep track of fair value? It's like, well, we have an investment manager who does that for us. Do you keep track of what's going on with liquidity of different asset classes and different asset types? Well, we've got an investment manager who takes care of that for us. So it's not just credit risk. There's so much more, given the kinds of investments insurance companies are making these days, that it's not just about credit risk. It's about a lot of other things. The risk committee. Most insurance companies have, a risk committee. So that kind of like parallel with the investment committee that analyzes, the risk of the portfolio, along with the risk that's on the liability side of the company's balance sheet. And what is the risk committee supposed to look at? Not just credit risk. They got to look at volatility. They got to look at duration. They've got to look at all these other things that can make the whole system kind of like break down. So what are the kinds of risk metrics? What are the kinds of things that we need to be looking for the insurance company to explain as far as their risk appetite? So I think all of you can chime in here and say, it's not just credit risk. It's everything else. When you're talking about investment grade corporate debt, yeah, it's basically credit risk. There's not much more, but you look at RMBS and you talk about cash flow variability, and that I could be investing in a 2-year bond today, interest rates jump up 150 basis points, now I got a 10-year bond. Or vice versa, or the reverse. So it's not just credit risk. It's all, insurance companies, their management systems, their senior management, their boards, their investment committee, they need to understand, what are the different risks in different asset classes, if not in individual investments. And then obviously from the standpoint of making sure the investment people talk to the actuaries, because how do you get asset liability management if everything is siloed? I mean, I think we all know that. So am I still doing this? Okay. So who's minding the store? We talk market volatility, it's way, way up. And I don't see that it's coming back down anytime soon. I mean, I'd like to see it come down at least just a little, but I don't see it coming down anytime soon. Liquidity metrics, when you watch everything that's going on with insurance company portfolios, liquidity metrics are all dropping. There's a lot less cash in short term. There's a lot less government bonds. There's a lot more structured securities, and the structured securities market is a more volatile, market. So the question is, what are the analytical systems that assurance companies should have? Obviously, again, this is driven by the kinds of assets that they have. If they've got just corporate bonds, investment-grade corporate bonds, have a great big, huge, massive Excel spreadsheet. That should be good enough. But if you're going to start getting into structured securities, you're going to start getting into mortgage loans, you're going to start getting into private equity funds and all that other stuff, they have to spend the money. They have to spend the money and get the analytical systems. They got to license Intex. They got to, go to BlackRock and pay $15 million for Aladdin. I mean, if they're going to be doing that kind of stuff, that's what it costs. You can't use an Excel spreadsheet to manage structured securities. It just doesn't work. And then my favorite question, talking about the board and having independent board members, and I always ask the question, who on your board really understands investment risk? And I bring it down right to the ground and I say, who on your board has ever sat on a trading desk and actually signed a trade ticket? I will tell you, as a person who did that, there is absolutely nothing so terrifying as signing a trade ticket saying, I think my insurance company should invest $15 million in something. That is scary. And when you go through that, you push, you find out, well, I'm getting an extra 50 basis points for this bond as opposed to that bond. Why? And the person who can ask that question is an independent board member who's been an investment person. Now, if they don't, then you figure out how you can cobble it together. I think there is a tremendous over-reliance these days among a lot of insurance companies on their investment managers. Crystal and I just finished an exam where we asked, they had a huge jump in RMBS, and we asked the question, explain this to us. And they said, we have an investment manager. It's like, no, these are your assets. They're sitting on your books. Explain this portfolio to us. It's like, so finally I brought it down to the nitty gritty. And I said, do you own any interest-only strips? And the answer from the CIO was, we don't believe so. So I will ask even Jim Stinson. I was like, is that a good answer? So watching for conflicts of interest. Obviously, this has to do with investment managers in general, but very, very focused on private equity fund owners of insurance companies and the whole idea of directly originated assets. They might be perfectly fine. They might be, in fact, very good investments. But from a governance standpoint, the board, the investment committee, they need to be asking the question, look, this is coming out of your system. Is there a conflict of interest? Is there the potential for a conflict of interest? Is there the potential for the impression of a conflict of interest? Is there a way that we can, if we start drawing the circles and the lines and the dotted lines and the bars and the boxes and the circles, that we find out that you actually are sending this money back? We worked on an exam last year where that's exactly what was happening. private equity put money into an SPV to act as reinsurance. The money which they were also the investment manager for was going back to them. And so that is a fundamental core governance question. And to the extent that a private equity-owned insurance company does not have a board that is asking that question, is there a conflict of interest? That is an outright failure. Now, that's my opinion, and you can take it for what it's worth. But it's part of the whole idea of asset-driven strategies. That this is based on what the private equity fund owner can generate in terms of assets. Next. What it means for insurance regulatory tools, which obviously is an important thing. I think fundamentally, and I've said this before, and I will say it, continue to say it. I think fundamentally, at the end of our analysis handbooks, our exam handbooks, they're good. They're good base core documents, but they're a starting point. They're a base. They're to give you some things to look for and how to check the boxes. They say, okay, this one, I looked at this one looks okay. I looked at this one looks okay. I looked at this, okay, I got to put this over to the side and look at it again. This one looks crazy. I'm going to call Dave Vaca about this because only he understands this. So that's what our analysis procedures, that's what the handbooks are for. They are not the be and all and end all. They are a base. They are to help you go down the path of risk focus, of being able to say, okay, these things are not that risky. I put them over here. I don't need to worry about those. These are things that are a little bit riskier. I need to ask some more questions. These are things that, okay, we could be heading into a rehab situation, which some of us from Oklahoma are very familiar with, to say, we don't be doing that. Don't be doing that. So but it's not a check the box. It is checking boxes to put it into categories of how you deal with them as we proceed. And then obviously we also have, thankfully to Fred Anderson and LATIF, at least for life companies or larger life companies, we have, AG 53, which I think has been very, very revealing to me, the answers that we get in AG 53, the filing, because one of the ones I looked at, it was great because, the filing says, categorize your excess spread, where did it come from? And one of my favorites was the column on the far right that said unexplained, which is like, what do you mean you can't explain it? And I said, well, look, I'm not a regulator, but as far as I'm concerned, if you can't explain it, you can't use it. It is, you have to be able to explain it. Okay, next. Do we have any more slides? Oh, we're done. We got 6 minutes left for questions. Or we could go back and do the intro that Crystal wanted to do and she didn't do. Jamie Walker's got a question. She's sitting at the edge of her seat.
The board, yeah. So it sits at the board, I get that, legal entity board, but how do you evaluate the overlay from the parent company that may have the affiliate asset manager sort of sitting off to the side and how much influence they have over the portfolios and the actions of the board at the insurer level?
Well, I mean, Jay, that's both a good question and a really, really complicated question. So the really complicated and nonetheless very vague answer is that it depends on the particular situation. I mean, at the end of the day, we function from the standpoint of legal entity. The legal entity has to have the structure. The legal entity has to have some ability to say, we understand what we're dealing with, we know what we're doing, we've got the data, we've got the... Now, to the extent that they can say, you know, all of that analysis is being done at a holding company level, and we get the good information, and we do a certain amount of checking to validate, and it all looks good, then I got no problems with that. But you know, fundamentally, we are talking about legal entity regulation, and you know, that's where we need to get the comfort level. And if that comfort level comes from board guidance, and to the extent that we're talking about, okay, who's on the board that has investment experience, if they're on the board of the holding company and they have a say in what's going on, I think that's good enough. I mean, I don't want to dictate, you know, specifics, as long as they recognize the general concept, that they understand that this is not just credit risk. That there's, you know, when you're going to get into these asset classes, when you're going to start dealing with the kind of market volatility that we've been dealing with the last 3 or 4 years, you have to up your game. You have to have more. You have to have more guidance from the board. You have to have more reporting up to the board so that they know what to give you guidance on. And if they work through that process at the holding company, as long as fundamentally it ends up being embedded in the legal entity, I don't have an argument with that. Was that vague enough?
Yes.
Okay.
Ed, to that point too, wouldn't independence play into that too, from the board, independence of the board at the legal entity level? So I think that's one other thing that Ed and I look at a lot too, is whenever, if there is that holding company and they are having, you know, a lot of effect on or say in that investment governance, is there that independence there at the legal entity to say that this is the right decision for the insurance company and that they're not doing something that's to the detriment of the insurance company? So again, back to Ed's point of who's sitting on the board, do we have, or the investment committee, do we have those people that can ask the tough questions? That's where that comes into play, because we want to know that they are asking those questions when maybe something's coming down. If it's an affiliated investment manager or a PE that's owning it, are they asking the tough questions to make sure that it's not something that's just going into the portfolio that isn't the right fit for their liabilities?
I mean, if unless there's another question, I mean, I will tell you again, you know, another anecdote. And when you get as old as me, you know, my brain is full of anecdotes. But you know, our investment committee when I was at Teachers, you know, and we called it the finance committee. You know, we had the chairman and the CEO, but the other 8 members of the finance committee were all independent directors. They were all independent trustees. So it was 8-2 in terms of the ratio. And we had people on that finance committee that were not investment people. And some of their questions were great because they were coming out of left field and I had to try and answer them. But we also had Paul Jagurtha, who was head of McCormick Resources. We had Fred Adler, who was founder of one of the original private equity funds. And they asked the hard questions. They never let you get away with, oh, I'm getting an extra 50 basis points. No, there is no free money here. Now, it could be argued that the risk that you're taking is a risk that is not that important to you as an insurance company because you've got stable liabilities and you can absorb that volatility. But I need to know, their responsibility was needing to know why you got those, because otherwise, just invest in treasuries. Anything else? Vaca, ask a question. Or I'm going to tell on you and then you're going to be in real trouble. Private letter ratings. So it's like you can't even say the name right. So private, you know, I think fundamentally, some different things. I mean, without naming names and pointing fingers at anybody, which I could do very easily. I think obviously the NEIC's action to say you've got to have the ratings, rationale letter. You need to understand why you got that rating. Not just, oh, I got a rating and I don't have to worry about the NEIC anymore. You need to understand, you have to have the ratings rationale letter. Ideally, you would, diversify. And, because you don't want to just get it all from one rating agency. There's 3 or 4 that are very, very big in private letter ratings. Spread it around. Make sure you get, because somehow you've got to replace the market oversight of public ratings. I remember when, occasionally from time to time, when S&P would do something about their ratings model for RMBS, and I'd call Tom Gillis and head down and sit in his office and yell at him, because that was all public information. They knew, everybody knew, and that's what the market does. When they change criteria, the market gets on top of them. That's not happening with private letter ratings. So somehow the management has got to replace that. And the easiest way to replace it is, you've got 4 that do private letter ratings. Spread it around, 25, 25, 25. And then you get, you're somehow getting the sense, yeah, they're a little too aggressive, they're a little too conservative. Okay? Good. Thank you, everyone.